I do always like to start off the show with a conversation about kind of what I saw happening in the market this week. I'm going to have Eason join me today too, because Eason's always asking me questions about the market. So some of the things that maybe you'd like to hear answers to also. So what we see here so far, the S&P 500 chart. This is for the year up until today. The blue line there shows kind of the 200-day moving average, and the red line I've just left in there is kind of the top trend line attaching a couple of the major points as far as that goes. So you can see what's happened this week. The market's down. And a big chunk of that down happened because of the core and top line inflation results that came out on Tuesday. So this is a consumer price index. It's a basket of goods that they look at, and in this particular case, we're looking at August and August of last year. How much did it go up? And it went up 8.3%, and the expectations were that it would go up 8.1%. It's not a big difference, but it was a big difference to the market, and there's some other pieces in here that are important also, but. I guess the one thing that we can hang our hat on at the moment is it wasn't higher than where it was, back in July, and you can see that actually June reported in July, but peak inflation was at 9.1%. So, we're going the right direction. It's just going so slow that it makes the market really nervous about what the Federal Reserve is going to have to do. And the Federal Reserve, this is called top-line inflation, and there's another thing called core inflation, which is what this chart shows here. Core inflation, they take out food and energy. And the reason they do that is because food and energy tend to be very volatile. Food prices are going up quite a bit. Gas prices are coming down a bunch. And that, those are all over the place. And the Federal Reserve often talks about core inflation because they feel like when they're raising rates, they have more impact on these core areas. And there's all kinds of pieces in here. Rents are one of the big drivers right now, but you've got all service areas, restaurants, alcohol, tobacco sales, and all these different things. Now, if you look at that chart shows something interesting because it shows a 6.3% core inflation as of August, so this August versus last August in 2021. And the important thing there is that we actually peaked out here in March, and we've been coming down month after month after month after month, and so that was fantastic because as long as core inflation's going down, the Federal Reserve maybe could lighten up a little, right? But then it jumped. As a matter of fact, it was supposed to be at around 5.7, 5.68, depending on who you listen to, but it jumped all the way up to 6.3%. And I know that seems like a small amount, but in the world of inflation, that's actually kind of a big deal. And of course, the direction is a big deal too.
So how does that affect, next week the Fed's meeting, they're going to announce rates. So how does core inflation going up affect, their decision-making process?
Well, when this report came out, the market was betting on a 0.5 point or a 3/4 point increase, right? And going back and forth, starting to get more and more towards a 3/4 point increase. But then when this report came out, all of a sudden now there's a segment of the market, right when this report came out, it was about a third of the betting was on a 1% increase, which is a big number, and 3/4 was the other 2/3. And so, and that's where, the more they raise rates, the more it should help inflation, which is good. So there's a segment of the market that sees that as good. They like it. They want more rates and higher. They think we should go for, I read an article talking about they should go for 2% on, next Wednesday. It's like, okay, just to get it over with and to really hammer things down. But the real concern for the market is there's a lot of things slowing down, right? And we're seeing housing start slowing down. We're seeing some companies. We'll talk about Federal Express later in the show because that was one of the questions that came up, but it dropped a bunch today, 23%, because they were showing that there's sort of a global slowdown in their business. And so when you raise rates, you don't see the full impact for 6 months. And so it's kind of a dangerous game. And they're raising rates based on some thought process for where this economy is going to be in March of next year. And that's very, very difficult. And the other thing is that people worry about is the Federal Reserve has just been so wrong. Right? The September meeting of last year, the Federal Reserve put out their statement. Their expectation was that they would not raise rates at all until the beginning of 2023. Just 1 year ago, they said that inflation was transitory, right? Temporary. and that they didn't need to raise rates in 2022. Wow.
Yeah.
Way off. I mean, we were raising rates at near record paces, 2 3/4 point increases. Now maybe another 3/4, maybe even a 1%. And so they can get carried away. And historically, they have gotten carried away because it's such a blunt instrument that has this huge lag to see what's going to happen. And so that makes the market nervous. Whereas inflation was coming down here, and just core inflation was coming down, and things were happening and moving along, the market would probably be really happy. And we were on a nice roll for 4 days in a row prior to the release of this inflation report. Because, if the trend is down, then the Fed is eventually going to be able to kind of back off. But when the trend goes up, it just makes it more likely the Fed's going to get more aggressive and have more chance for a mistake and create this hard landing with companies' earnings being wrapped up in that hard landing, right? And that's one of the big things. So, yeah, it is interesting to see what's going on, and we talk a lot about the Fed, because it's the big driver, really, because we're talking a lot about inflation as far as that goes. And so, what happened this week, at least from my perspective, that was kind of important, and just to let everybody know, over a couple week period, we reduced our stock market exposure. We got rid of about 18% on average of our stock market exposure. So if you had a 100% portfolio, you were down to 80%, stock, 82%. If you have a 60% portfolio, you were a little bit below 50%, 48 or something like that. And it's not even, it goes all the way across. And just so everybody knows, when we reduce positions, we don't worry too much about anything to do with the IRAs. We do those and keep them right on the model because there's no taxes.
Yep.
The taxable counts is totally different, and so we don't want to take big gains. And so we've been selling things, that are in our models that have less than a $10,000 gain. And so everybody's got different experience. Some people have huge gains in the same position somebody else has a loss in, just because of when they became a client or when that money came in, as far as that goes. So, and then as of Wednesday, the day after that big drop that we had from CPI, we actually made a much bigger move. We moved another 26%. We essentially got a sell trigger on our S&P 500 positions. And again, we sold what we could sell without creating big gains. And it was a really big move for us because we have a lot of money in that. And it worked out so far. I mean, as we sit right now, the S&P 500 is about 3.2% below where we sold. So that looks good, But the trick is getting back in.
Yep.
So we'll see. We do have a process. We do have ideas on when this is going to happen. But at the moment, we're just moving money to T-bills and ultra short-term bonds as a holding place just to protect. Because that's a fairly significant, that 3,900 was a pretty good support level. And we basically gap opened right through it this morning. So again, I'm glad that we have what we have on the sidelines kind of out of play here. Because the next support level isn't too far away. It's about 2-3%, about 3,700 on the S&P 500. But really, the next support level past that is what worries me. I have to go back to a 3-year chart here. And you can see, and these aren't randomly drawn. These are all concerning volume and volume profiles and all kinds of things that I won't bore you with. But that line is the next significant support. There's a pretty big gap.
Yep.
And that's about a 13% drop from the previous support. So, again, I'd rather have some money on the sidelines in case that does happen, because here's the one thing I do see in all of this is that we have a chance here if the market does fall, and we have money in treasuries and ultra short-term bonds that don't fall, essentially, or much. If they do, they're kind of stable. To be able to take that and buy back in at a lower point, right? We'll see. I mean, things could turn around. The one big event that's happening next week that I think is pretty interesting is just the CPI meeting.
Yep.
Right? So, I'm sorry, the Federal Reserve meeting that are going to be discussing what to do about CPI. And so, what do they do with rates? If they go 3/4 point, right, there is basically a third of the market or so that thinks it's going to go to 1%. So if they go 3/4, I think the market actually moves up on 3/4. If they go to 1%, it goes down probably because, again, 2/3 thinks 3/4. And so, because the market's trying to factor in these different increases and such that are happening. And then in the question and answer periods, when Jay Powell gets out there, The last one that he did was in July, because they don't do one in August. The market went up and up and up, and we had a really strong run because it interpreted a few of the things that he said, as positive. So that's why I'm going to kind of hang on to, what we have still exposed to the market to see what the results are, how the market responds to that meeting as far as that goes, because we do have triggers on a majority of our assets as far as that goes. So we'll wait and see what happens then, because you can get a pivot that the Fed causes. The problem with these pivots that move up, the Fed doesn't want the market to go up, right? And so then they, once the market moved up after that July meeting, they spent a lot of time, including this big Jackson Hole speech, pounding that they were going to just essentially kill everything in sight if they had to, in order to make the inflation go down. And they were warning stock market participants. And the reason they need the stock market to go down is because we tend to spend more when our accounts are worth more. And they want us to spend less and help out inflation. So part of their inflation fight isn't just raising rates, it's also talking. It's what we call jawboning, right? And so be very interesting. It's a lot harder, actually, when he does the Q&A session. When they did Jackson Hole, 8 minutes, no Q&A. He could stick to a script and hammered the market. It worked. It took out almost $1 trillion, $998 billion that day in that 8-minute speech off the market here in the U.S. But he's going to have a question and answer session where they get to ask, and sometimes that's where some of the other softer comments come up. So anyway, that's what's happening. We've got a defensive position. This isn't something we want to do. It's just something we feel is important to do here because the downside risk is higher than the upside potential, in our opinion, at this point. But
so how would you get more defensive, or say the market breaks that to where it's that 3,700 and it breaks through that 3,700?
Right.
What's the next step after that?
Well, certainly. It's something we're working on right now. We'll either move more money into the T-bills and ultra short-term bonds, or we may move some money into the inverse positions, like ProShares short S&P 500. It goes the opposite direction for the most part as the S&P 500. And the reason we look at those inverse positions is not so much to make money per se, is because we have positions that clients have that they can't sell without a big gain. So we sold Microsoft and Apple for most people a while ago. It was good. It was probably down 5-6% since we sold, and so it was a good thing to be in T-bills for that. But we didn't do it for everybody, because some people have huge gains, $100,000 or whatever it might be. And so the way to kind of hedge for those people is to take a portion of our portfolios and put it in something that goes the opposite direction. So that way we don't have to sell, let's say Apple, which I like, generally speaking, that has a $100,000 gain. We can put that into this inverse position that goes the opposite direction of the market. So if Apple does drop, they'll have some offset, right? It's a tough one. Those are the real issues that we're looking at here. So, one of those two things will happen because, we only have a few positions even left in our overall models as far as that goes. So I hope things turn around. I hope things take off. I hope the Federal Reserve, gets to a point where they can start letting us have a higher market. But in the interim, I think that's the strategy. So, all right. So that's our summary for the week. Thank you so much for listening to this, and hopefully I'll be able to, talk to you again next week about this also.